Welcome to your commercial-free, uninterrupted investment show, sponsored by the SEC-registered investment firm, Wilsey Asset Management, a fiduciary firm owned and operated by President Brent Wilsey, who has been putting clients' investment needs first for over 40 years. The Smart Investing Show has been giving unbiased financial information for over 27 years on local radio stations right here in San Diego, providing you with fundamental analysis on stocks and investments you want to know about. Now, here are your hosts, Brent and Chase Wilsey.
Well, hello, and welcome to the Smart Investing Show. I'm Brent Wilsey, president of Wilsey Asset Management, and Wilsey Asset Management is the proud investing partners of the San Diego Padres. Thanks for joining the show today. We got a lot of things to talk about. We had the jobs report came out, so we're going to talk about the jobs report, and also a jobs report that is always preceded by the job openings, which is called the JOLTS, Job Opening Labor Turnover Survey. We'll discuss that as well. Also, to talk about shopping malls, what's going on there. Probably worse than maybe expected, but there are some bright spots there. We'll discuss that. And also, to trucking company, Yellow Truck. Well, unfortunately, they got the red sign. They are no longer, well, they'll probably still be in business, but operating under bankruptcy. Chase, what do you got?
Well, hey, as always, you want to join the show so you don't buy a yellow truck company that goes bankrupt. You got a stock you're looking at buying, selling, or holding. Give us a call here. We'll break down those fundamentals for you. Phone number is 833-288-0973. Again, that's 833-288-0973.
Okay, well, let's get started with the jobs report because that's always a big thing, and it really moves, can move the market, can move interest rates, concern about inflation. You want a market or a jobs market that's doing okay, but yet you want some negative signs, so there's no risk of the Federal Reserve raising rates. So let's talk about the report. The jobs report showed non-farm payrolls grew by 187,000 in the month of July, which missed the estimate of 200,000, which is a good thing because that is kind of on the negative side for the Federal Reserve. The unemployment rate did tick down, however, to 3.5% versus the estimate would hold at 3.6%. Now, areas of strength included healthcare and social assistance. Up 87,100 jobs were added. Construction surprised me a little bit here, up 19,000. And leisure and hospitality, no surprise here, a positive 17,000. Healthcare in particular has been on fire lately, as that has accounted for 35% of the job gains in the past 3 months.
Now, there were also some signs of weakness, unfortunately, in the economy, which included manufacturing. That was down 2,000 jobs. Professional and business services down 8,000. Transportation and warehousing were down 8,400. And then information was actually down 12,000. Now, I did want to point out, looking at manufacturing, it's kind of interesting. It was down, but we talk a lot about these manufacturing plants that are being built. So it's kind of funny because I think that's where the construction jobs are coming from, is to build these plants. But the manufacturing jobs aren't there yet because the plants aren't finished. So you could see runway in the manufacturing sector over the next couple of years.
You got to build the manufacturing plants to have the workers do the manufacturing.
Exactly. But also to look at professional and business services, they were actually weighed down by a loss of more than 22,000 jobs for temporary help services. And a lot of people pointed this to as a negative. And I still think that it could be positive because there's a lot of people that we know are trying to keep their employees. And we know how hard it is to train employees and to, get new ones, essentially.
Right.
So it could be that more companies are shifting away from temporary just to try and find those permanent workers. And I don't necessarily think it's good news or bad news. I think people are just trying to correlate the fact that this was an issue back in, I think, 2006 and 2000 before the last two kind of recessions there.
And it's always been kind of a thing they look at, that temporary workers means that you're so busy you have to hire temporary workers, where when things slow down, you're going to get rid of them. But I think we have a different job market, different employers to where that doesn't apply any longer.
Yeah, I just... people will try and pick out one thing that was the same as in like 2006, 2007 and be like, oh, it's going to happen again. And it's like, that's just one little factor. You're not looking, we talk a lot about the debt levels in 2007. Right. Debt levels are nowhere near that. So I'm not worried about it. We'll keep an eye on the overall employment situation, but the temporary help, especially being such a small part of the economy, I don't think is a big deal. The other thing I did want to point out was wages were actually a positive in the report, as average hourly earnings grew 4.4% compared to last year. This surpassed the estimate of 4.2%. And what I look at is, at this rate, I would say the growth is not excessive, but is also growing above the recent inflation rate, which is good for consumption as real earnings are actually increasing. Overall, I got to say, though, I mean, I would say this report is not very exciting, as it really just kind of shows us what we've been talking about, that the labor market is softening, but it still remains in a good spot overall.
And it's not exciting, but it's a positive, because we don't want exciting in the job market, because that would cause the Federal Reserve to increase rates even more. So I think this is an exciting report because it's so dull. That's a positive thing. It's what we needed.
Yeah, it wasn't really good or bad, which is what we call that Goldilocks situation, where it's not too hot, not too cold.
Right. And when you did have still 187,000 jobs added, that's still a positive. I mean, I would even be okay with a flat jobs report, because that means everybody's keeping their job. We don't want to see that reverse and have 200,000 jobs lost. So we're still on the positive side. Even a increase or decrease, we'll say, of 10 or 20,000 jobs would still be okay, probably even better, because the Federal Reserve would probably then really kind of pull back.
Yeah, no, I agree. I mean, they say bad news is good news at times, so it's something to consider there. And I still think I'd like to see somewhere, if we get to a spot where we're adding like 50,000 jobs a month, that'd be, I think, a great spot. I mean, you can't go to 3% unemployment, 2.5% unemployment. That's just not going to happen. So, you have to understand that slowdown is going to occur. And you talk about leisure and hospitality, I had like 17,000 jobs. I mean, at the beginning of the year, they were averaging like 67,000 jobs. So, I mean, things are slowing down, which is overall positive, because we don't want to overheat. And that's where inflation comes in. And that's where, oh my gosh, what do we do to now combat that inflation? We got to raise rates even further.
Right.
That's what could be troublesome. I don't see that happening.
And they say around a 3.5%, actually 3.5% is pretty much full employment, because you got people that just don't want to work, or they got laid off or quit, and they just want to take time off. And you'll never have a 0% unemployment. You're always going to have some people unemployed. And I think around 3.5% is what they consider full employment. You got everybody working that wants to be working.
Well, and you have to consider the thing with the unemployment rate is it's based off a survey, which is kind of funny. It's like, hey, have you been looking for a job? Yeah. What have you done? I don't know. I looked at an ad.
Right.
Okay. You're unemployed. So, it's not a perfect science, and that's why you got to look at all the different numbers. So, you're not. That 3.5% includes people that are very loosely looking for jobs, and they may not need one, but like, yeah, I kind of looked.
And it could be people where, a couple and the housewife, she didn't have to work, but I'll go to get a job, found this job I kind of like, and that job ended. She doesn't really have to work or want to work, but she's looking for something she really wants, because she doesn't have to. And again, that's where it is. And there's other people too that are maybe retired. And they don't have to work, but they do. And then the same situation, they might lose that job because, for whatever reason, I don't need the job, but if I found something I liked, I would do it. So that's what you kind of get to. You don't have the people that have to have a job. So with that, let's talk about job openings, because in the month of June, about 9.58 million were below the estimate of 9.7 million, and they were at the lowest level since April 2021. Compared to last June, that they were down 12.6%, or by 1.4 million openings. This sounds troubling, but it's important to understand there are still 1.6 job openings out there for every available worker. Also, even with the decline, we still have a very strong labor market.
I mean, you got to, again, look back to history. And I've talked about this a lot with COVID. You've had these wild spikes, and we're kind of normalizing in the economy. Because if you look back to February 2020, job openings totaled just 7 million. And obviously, this is before COVID. In 2019, they averaged 7.2 million per month. Again, 9.58 is where we are. We're still 2.38 above what we averaged in 2019, which many considered a very strong economy. Also, you look at layoffs, they were a positive in the report, as in June they came in at just 1.5 million. Sometimes, oh my gosh, that's a lot of layoffs. Well, it's all relative. You have to look at numbers compared to other numbers. In February 2020, again before COVID, layoffs were close to 2 million, and in 2019 they averaged 1.8 million per month. So the labor market, as I said, well, it's going to continue to soften as the economy normalizes from COVID that really disrupted things just a few years ago.
And one thing I learned a long time ago, a number means nothing at all unless you have something to compare it to. And a lot of people say, wow, 1.5 million, that's a lot. No, it is not a lot when you compare it to, again, 2019, very strong economy, which we have now. But it was much more than that. It's about 20% more. So you've got to understand numbers and how to analyze them. And that's what we do here on the radio show. That's what we do in our newsletter. That's what we do when we manage our clients' money is we analyze the numbers and say, wait a minute, what does that mean? We always say why, not just, oh, that's what it is. Like, no, why? And how? What can we compare it to see how does it make sense?
Yeah, I mean, it's kind of like what I was saying just here shortly ago, where people always try and look for the bad,
right?
And they're like, "Oh, that's bad. Well, why is it bad?" I mean, there's so many other good things, and we've talked about this a lot. Where if you pick one point, you're never going to be happy. You're never going to invest. We don't live in a utopia where everything's perfect. It's just not the reality. And quite frankly, if you invest that way, your investment returns are going to be terrible over the long term. Because as I said, you're going to sit in cash pretty much your whole life because there'll never be anything that is going to be a viable investment to you.
You're nervous Nelly, as they call it, and you're always going to be nervous because there's always something to worry about, and you'll never invest. And again, a bad number can be good because we talked about now where the Federal Reserve wants to see things slowing down. So here's another thing with the job openings. They're slowing down, but still 1.6 job for every job opening or person looking. That's still phenomenal.
Oh, yeah.
So, let's go ahead and open the phone lines. We've got one more thing to talk about, but the phone number
is here. Things, but.
Oh, two things?
Yeah, we got the yellow trucking company as well.
Okay, I always forget to give out the phone number early. So I'm going to do it now since I'm on that track, and people have to wait a little bit. But if you want to join the show, call in for that unbiased, no strings attached, fundamental opinion about what you want to talk about, give us a call, 833-288-0973. Again, that's 833-288-0973. Be a little bit patient because I jumped the gun too quick. We got two subjects to talk about. And one is the shopping malls. It's no surprise that malls were big 10, 20 years ago. Well, they're now struggling. That has caused a problem where malls are now worth 50 to 70% less than the valuation peak, which was back in 2016. Roughly 20% of all malls financed through commercial mortgage-backed securities are underwater because the loans are much bigger than the value of the property. What has been hurting the malls is large anchors like Macy's, JCPenney, and Sears have closed nearly 900 department stores between 2018 and 2020.
Now, looking at this compared to 2016 to 2017, there's a huge jump, as during that time frame, they closed just 175. So 900 compared to 175. I mean, that's a huge, huge difference. Hard for those malls to handle that. But very important to understand, not all malls will go out of business. What has worked is newer, well-located properties that have strong tenants and have generated healthy traffic. A good comparison here in San Diego would be the North County Fair in Escondido, which looks like a ghost town, compared to Fashion Valley, which is in the middle of a remodel and still has a good amount of traffic and stores worth going to. I would caution investors to be wary of trying to pick up bargain prices on these properties. I'm sure some will survive, but I would say overall in 5 years we will see many less malls that just are not worth risking the capital at this point.
And it is true. I mean, and I understand what when I read what I was reading, but I don't understand like a Fashion Valley. And right now you go down there, it is terrible because I got the construction in the middle and so forth. And there's still people there, but I try not to be in the sun because, well, sun's not good for you. You get skin cancer and so forth. Where you go to North County Fair, it's all inside, which is better. But it is like a ghost town out there. Maybe it's because of location too, with Fashion Valley is more centralized, and North County Fair is just North County.
You got to remember, we live in San Diego.
Right.
I hate going to that mall that's inside. I like being outside. I mean, I was
You'll regret that one day when you get skin cancer.
Well, there's still a little bit of sun is good for you. Actually, you got to get your vitamin D.
Vitamin D, okay.
But not excessive amounts of sun. That's what you got to look out for. But I was going to say, I was surprised you used Fashion Valley because I like UTC. I think UTC.
Oh, yeah.
That's my favorite mall in San Diego, personally.
You know what I hate about UTC? Is you got to pay to park and you got to wait to get in and out. I mean, it just irritates me.
If you're there for less than, I think, 2 hours,
but you still got to wait in those lines to get in and get out.
Yeah, I know. But it's always packed.
Right.
I mean, it's a busy mall. But I was going to say, I mean, relating this back to the investments is, there's like a Simon Property Group.
Right.
They own a lot of great properties. And I was looking at them because I was intrigued. I was like, we did this, actually, I'll give a little secret here. We did this with an office real estate investment trust because we think there's very similar situation that everything's just kind of being tossed out right now. And if you can find the good properties that are survive, they'll be fine. and you're getting bargain prices for the good properties. You don't want to buy the bad properties at bargain prices because they may not last. But Simon Property Group, their balance sheet just doesn't make sense to me. Their debt to equity looks way too high. Now, there could be some just accounting to that, but it's something that would take a lot more research.
Yeah, because we hold a couple of REITs in our portfolio, and if I was going to be investing in a REIT that held shopping malls, I would really want to know what areas they're in. And you really got to do a lot of research because, again, we talked about UTC and Fashion Valley both doing extremely well. But North County Fair is not. I don't know. We don't go to East County. There's one out in East County too.
I'm not sure.
Yeah, I mean, it just some do extremely well, and I don't see them turning around.
Yeah.
And that's the problem. We try to find businesses that we see are having a short-term problem. I don't think it's a short-term problem. And there will always be some type of malls like the Fashion Valleys, UTCs, but there's going to be a lot less, and you got to be careful to invest in the wrong ones.
And I do want to point out, I don't go to UTC because of the shopping. I was just thinking, I mean...
Oh, you and I don't like to shop.
But the thing that I think UTC has done well, they have so many great restaurants there. And that's where I kind of go, and I think about, the North County Fair. They have BJ's, but they have Red Robin, which I used to love Red Robin. I don't even know if they actually still have the Red Robin. I haven't been up there in so long, but I mean, UTC has, the winery, they have Javier's, they now have like Board and Brew. They have a bunch of different like restaurants that are just really good. That's why I like going there.
Yeah, more for the restaurants.
And that's where the experience comes into play, and those are going to be the malls that are going to survive, not the ones that I think are just relying on transactions, essentially.
Yeah, you've got to create that experience to get people there. And I like Tommy Bahama shirts. They got a restaurant there. I just like going there. So again, you're right. It's for the restaurants and the experience of going there. But I hate shopping. So, all right, let's move on to trucking company. We're talking about the trucking company Yellow, which was forced into bankruptcy because of three things, in my opinion. The first was bad management, which caused a second problem of acquiring companies and piling on debt. This includes acquisitions like in 2003 when they bought Roadway for $1 billion, and just 2 years later they bought USF for nearly $1.4 billion. Number three was labor costs that were pushed to high levels by unions and their 22,000 workers.
Now, important to understand, approximately 7,000 employees were actually non-union, and this company actually filed bankruptcy in 1951. Then again, in 2010, they wiped out most of the shareholder value to get the union to agree to cuts of benefits and pay. They also had issues with bankruptcy in 2014, and once again during COVID in 2020. So this is by no means a company that has been healthy for a long time. The company may still continue to operate in bankruptcy, but the shareholders will likely lose most, if not all, of their money. Also, old contracts are worthless, and the bondholders may get some type of a deal. Roughly half of the company's $1.5 billion in outstanding debt was actually owed to the federal government, who loaned the company money during COVID to keep them afloat. And this is why at our firm, we just pay close attention to the balance sheet and debt levels, because you never want to be stuck with a business. All of a sudden, it's like, oh gosh, I went bankrupt. I'm screwed.
Yeah, you pretty much lose everything. Every once in a while, you'll see one that, they like before. And we had Yellow Truck before you came over. I bought it. We did okay on it. And then I started seeing the problems. I started seeing the leveraging of the balance sheet. And we got out. I know we took a loss of, 30-40% or something on it. But they did go virtually bankrupt, and they wiped out the shareholders again. So this is why we do spend time looking at the numbers. Why, when we buy a company, it's 10, 15, 20 hours of research before we invest into it. And after we get that business, every week we look at the numbers of the company, of all the companies we hold in the portfolio. Every quarter we go over what's going on with the financial statements, what's going on with the conference call, what's going on with the business, because you're an owner and you've got to watch that business. I always use a comparison that if you had the local 7-Eleven, you're not going to buy it and then not go there for a year or two. No, you're going to go there once in a while. Is the parking lot full? What's going on? Why is this here? Why is the inventory low? You're going to look at that business the same thing we do. Just because we own a small piece of that large business, we still do it that way to make sure that we don't fall into a Yellow Truck where we lose everything.
Yeah, and I did want to point out for people, too, it's like, oh my gosh, 30,000 people lost their job. I talked about the layoffs at, 1.5 million. So 30,000 is a very small portion of that. And also, too, I look at just, I kind of compared it. I did a segment on Fox 5 this past Wednesday talking about what to do if you lose your job that was prompted by the situation. I was just kind of curious. I mean, you look at companies like FedEx and UPS, they each employ over 500,000 people. So Yellow Truck wasn't a big company. And I said it wasn't like they were a well-run company that all of a sudden fell into hard times. I mean, they've been troubled for many, many years.
And that business will find its way somewhere else. And again, they can operate in bankruptcy, gives them time to. Well, there's different type of bankruptcies. I haven't read which one it is yet because we don't follow this company. But that business still has to be fulfilled. And they actually did what they called, was it light truck loads or something, to where they don't fill up the whole load with one company. They can go to Walmart, pick up a partial load there, go to CVS, so that was their niche they kind of did. Somebody else has to pick that business up because Walmart, CVS, all these companies still need to get their inventory to the stores.
Yeah, less than a truckload, yep.
Yeah, so.
I mean, it's something that I'm not really worried about it hurting the economy at all.
No, it is such a small amount, and those people will find other jobs. I'm trying to think who the big trucking company is that is out there that's going to take over for Yellow Truck.
I mean, it might not be another. I mean, because you got to think too. I mean, there's going to be the assets with the trucks. There's going to be the workers. There's going to be. They also had logistics there as well, which I know FedEx, UPS do the logistic part. So it could be dispersed among many different things. I mean, you have your Amazons, your FedExes, your UPSs that could maybe be buying those assets. And then you have, your, what is it? I think it's Knight or Swift. Or there's one other trucking company.
Yeah, I can't think of what the other trucking company is, but they'll benefit from that. So actually, maybe if that's a public company, the other one, they should have a big benefit because, let's give them the business, so they should see an uptick in their business. But I can't think of what the other big one is.
There's also small companies, small businesses that could be vying for that more regional business as well.
True. So, all right. Well, all this information comes from our newsletter. The newsletter goes out every Friday at 5 o'clock. There's more in the newsletter. We talked about counterfeiting over the last 9 months. The Secret Service has, I can't flip the page. has $52 million of $100 bills that paces fake bills. We'll talk about that in the newsletter. Electric vehicles. We talk about the recession. We talk about the profits of Anheuser-Busch, Tesla stock. So many different things on there. It goes out every Friday at 5 o'clock. You can get it on our website. Go to the website, smartinvesting2000.com. That is smartinvesting2000.com. It is free. All you have to do is sign up for it. And a lot of people have really been going to that newsletter because they like it. They said it's short, concise. I get a lot of information out of it quick. It's they say it's really well written. So.
Yeah. And real quick before we go to the calls, I did want to say something that we've been talking about a lot, and it's just the concentration of the market, and the impact that Apple can have on the market.
Oh yeah.
You look at Apple's a huge component of all three indices, the Dow, the NASDAQ, and the S&P. With Apple being down 4.8% yesterday, it really weighed heavily on all three of those indexes yesterday. And something to keep an eye on. And it was funny, I was watching CNBC yesterday, and this analyst was on, and he goes, Apple, I think they did a phenomenal quarter. And
what?
Yeah. And he goes, the haters were proved wrong yet again. And the anchor goes, the haters? What haters? Everybody loves Apple. And it's just funny because I was like, what are you talking about? Like, there's no short position on Apple. Like, there's not any, which is one reason we don't like it, is because everybody loves it. Which all of a sudden problems start to ensue. People say, I'm going to take some profits. And there's not really a bottom that's found until Apple falls. I mean, it still trades at 30 times earnings. And now it looks like they're going to have 4 consecutive quarters based off their guidance of declining sales, which is not a good spot to be for a company that trades at 30 times earnings.
And that's declining on the growth of the sales. Or sales actually declining.
Not decelerating, declining.
Wow.
And we're talking about 1% to 2% year over year. But if you're trading at 30 times earnings, you can't be having declining sales. And it's still coming from their iPhone sales, which are still such a big part of it. But people are all excited about their service revenue. Service revenue was up 8% year over year. It's not, in my opinion, justifiable to trade at 30 times earnings.
Yeah, and I've not read deeply on the conference call, but I have listened to some different people, read a little bit on it. I question the same thing, and this is what we said with that. Great company. I mean, we both have Apple phones. You have the Apple computer. I have an iPad. Great products. But again, as a business goes, you shouldn't be paying such a high price for a business that is actually declining in sales, not increasing. And I think they do a great job of sugarcoating it, but it's just one that I don't see. And people think, oh, Apple will never go down. Well, it will, because eventually the truth comes through, and people eventually will say, I just think maybe Apple won't do as well, and they'll start selling it. A lot of people sold on Friday. There
was actually some, they were talking about on CNBC, because it's still a lot of the retail crowd and people, they were talking about on CNBC saying, are people maybe going to be selling Apple to buy Amazon now? Because we don't have as much money in the economy, so you have to start making harder choices at the end of the day on your investments. You can't just throw money at anything and it goes up, because our money is starting to contract in terms of the money supply. So they were saying, it's like, well, these retail investors might be saying, Apple is just not going to grow as much. And then Amazon reported a good quarter, still too expensive for us to invest in.
Yeah, still 50 times earnings, I believe.
And they're over the last 3 years, you're still actually down on your investment in Amazon. It hasn't done very well, but they're saying, maybe the money will start moving around there. And I'm not saying that's going to happen, but it could be that catalyst where it starts to take Apple down slowly over time, because there needs to be more money coming to Apple. And the problem is, when everybody loves it, who is left to buy it?
Yeah, and that's what we said. You've got to have that downturn to have people start selling it before you get a good value. And then you don't want anybody loving it, because that means people are going to start selling it. And Amazon, just a quick comment on that one. They talked about how great the AWS, their cloud services was. I think it was up 8%. Well, how do you remember before they had such a high multiple? Because it was like 20 to 30% growth. So, yeah, they're still growing, but 8% growth for a 50-time multiple? I don't know.
I thought their growth on that was better. I know the stock was up close to 10%, but or it might have been
on AWS. Is
I thought AWS grew more than 8%.
That's what I thought I heard.
Yeah,
I don't have it in front of me, so but I believe that's what it was, and you can probably look at it if you want to. But
either way, trade at 50 times earnings. It's just too expensive for us.
Right, and. Yeah, and we've kind of looked at it like, it's down. Should we buy it? Nope, still too expensive. So, but we'll watch those. All right, let's go to the phones here. Phone number is 833-288-0973. That's 833-288-0973. Let's go down to Bonita and speak with Milt. Milt, you're on the Smart Invest Show. Brent Chase, how can we help you?
Well, good morning, and thank you for being there, you guys. You guys put on a wonderful educational program, which I really appreciate.
Well, thank you.
The stock I'm looking at and have looked at is VICI. It's a gaming stock out of Las Vegas, and I believe it owns the Bellagio and the Mandalay, and also getting into golf courses, and it looks like the PE is pretty reasonable, around 14, and pays a nice dividend. My question kind of is that a qualified dividend, or is that just a return of cash situation?
Well, actually, we'll answer that question for you. It's not a qualified dividend because it's a REIT, so it is fully taxable. So, yeah.
Okay.
So
but if you hold it in other accounts, like retirement accounts, that's helpful.
So, but let's look at the numbers here for you at Milt there. Again, the company is Vici. Their symbol is VICI. They're in a REIT diversified industry is where they're at. About 2.6% short on the float, so people aren't shorting this REIT at all. We do see the PE ratio about 13.9 versus 28. That's a positive. Price to sales are expensive, 9.3 versus 6. Price to tangible book value, 1.3 versus 1.1. That is good. And price to cash flow, 15. That's slightly above the industry at 13, but you got a good PEG ratio of 1.8 versus 25.6. And the lower the PEG ratio, the better. Now, we do see that the earnings over the last year are up 136%. Sales climbed by 79.4%. Those are pretty high numbers. You want to understand why those are so high before you invest in the company. You do get a nice dividend of 5%, and they only use about 70% of their earnings to pay that out, so that's a positive. Now, this is a REIT, so you got some strange numbers here. The current ratio is 29.5 versus 6.5. You really got to look at the financial statement to understand this a little bit more. Debt to equity is okay, 0.7, same as the industry. Net profit margin is 65%, and then that compares the industry at 10.5. Return to equity is 9% versus 7.5. Chase, what do you got?
So current price here for, again, Vici, ticker symbol is VICI, was $31.06. 52-week high here is $35.69, and the 52-week low is $28.49. If you go out to December 2024, very important, again, with the REITs, or the Real Estate Investment Trust, we look at FFO, or funds from operations, kind of more of a proxy for cash flow, since, again, real estate companies have a lot more depreciation, which is going to weigh on their earnings. So we look at the, again, FFO, which stands for funds from operations. But we go out to December 2024, that FFO estimate is $2.56. It gives us a target sell price here of $42.50. So, I mean, the valuation on this company is very strong. And even with the taxation of that dividend, it's still a 5% yield. So comparatively, on an after-tax basis, your yield is still going to be pretty darn good. I mean, depending on your tax bracket. I will say as well, living in the lovely state of California, it doesn't matter what type of dividend you get. It's going to be taxed on that tax bracket anyway. So it's just more on the federal side where your federal tax bracket lies.
Yeah, and this is one of those investments that I think is a good investment. I think the company's on sale. The REIT's on sale now. I would not expect a 30, 40% return, but with that nice dividend, where they invest their money, how they invest their money, I think long-term, you're pretty happy with this, getting a 10, maybe a 15% average return per year.
I mean, their growth on the business has been phenomenal. I mean, they've done a lot of acquisitions, I know, and their sales and their FFO has grown tremendously over the last few years, and it looks like that growth still has a runway. It's not going to grow at the same pace, but again, you can get mid to high single-digit growth on FFO, cash flow. Is a good business to hold.
Yeah, so
they're getting into golf courses also, aren't they?
Yeah, they're doing some different things there besides just casinos and gaming. So, yeah, they are trying to expand a little bit into other areas. So, it's just a well-run business. They have done acquisitions. I don't know if they'll do any in the future, but it's just one that it's I don't want to say it's a sleeper, but it's one that you can invest in. Don't look at it. I think in 2-3 years you'll wake up like, oh, yeah, we did okay on that one.
Yeah, it's not one that I think would double this year or anything, but, get a nice 5% yield, as Brent said. Hey, I mean, you get 5%. Plus, let's say you get 3 to 4% growth on that stock price. I mean, shoot, that's an 8-9% return on your capital. That's not bad.
Yeah, and then if you do gamble, you go to Vegas, you feel a little bit better because you're spending your money on what you invested in.
Yeah, I know. They can take my money, but they're going to have to pay some of it back to me. Yeah. Oh.
All right. Well, Matt, so let us know if you buy it or not.
Okay. Well, yeah, I already did actually.
Okay. All right.
So, look at Modine sometime. MOD. I talked to Chase years ago about that one, but just put that on your calendar and take a look at that. That's a very very interesting play.
Yeah,
part of my family invested in that to begin with back in the 1800s. So anyway, Thank you guys so much. Okay, and appreciate your show.
Okay, Milt. Thanks for calling. Have a good one. Bye-bye.
Thank you. Bye-bye.
All right, that does open the phone line, 833-288-0973. Again, that's 833-288-0973. I do see that Jim in San Diego is on the line, but I also see Harrison, our financial planner, is here as well. So let's go ahead and talk to Harrison, our financial planner. Good morning, Harrison. How are you doing this morning?
Good morning, guys. I'm doing well. How are you doing?
Doing pretty good. I'm looking at today. You're talking about today home and auto insurance. This is a very hot topic here and in Florida. So I'm going to turn the mic over to you. Let's talk about those two things there.
Yeah, what got me talking about this, there's a lot of carriers who are leaving California. State Farm, Allstate are some of the bigger ones, but there's a lot more. So what people are finding is they're either unable to renew their insurance, or their premiums have gone up a lot in the last few years, or they're trying to change coverage, and they're finding that a lot of companies aren't selling new policies in this state. So when you're shopping for insurance, it definitely helps to work with a broker who is contracted with multiple carriers, as opposed to an agent who works just with one company, even though right now it can still be tough. As far as some of the details of the coverage to look over, one of the things to look at are the deductibles that you have. So if you submit a claim, you have to pay the full deductible before the insurance coverage kicks in. I personally like higher deductibles because home and auto claims aren't that common, which means you shouldn't be paying that deductible too often, and a higher deductible will lower your premiums. So right now with premiums going up, that's one way to help offset that. Next, another thing to take a look at is your liability coverage. So this protects you if you get sued because you cause a car accident, or if someone gets hurt at your house or something like that. This is an area you don't want to go too cheap on. For homeowners insurance, I would say you want at least $300,000 to $500,000 of liability coverage, and for people with larger amounts of money, higher net worth, you might want to add some umbrella insurance to that as well. And then for auto insurance, it's illegal to not carry liability coverage, but the state minimum is pretty low. In California, it's $15,000 per person, $30,000 per accident, and $5,000 in property coverage. But if you get in an accident, the damages are almost guaranteed to be more than that, and you can be personally sued to cover the excess. For auto, you want at least $100,000 a person, $250,000 an accident, and $100,000 liability coverage for property. Next, another thing to take a look at is your uninsured or underinsured liability coverage on your policy. This protects you if someone else causes the accident, but they don't have insurance or they don't have enough. In California, 1 in 6 drivers don't carry insurance at all, not to mention how many just have the minimum coverage. So this is something that's really important that a lot of people don't think of. I have a story about 2 months ago. My brother-in-law was hit by a drunk driver who was on a suspended license, had multiple DUIs, did not have any insurance, so a real upstanding citizen, and it almost killed my brother-in-law. He had to be airlifted to a hospital, surgery after surgery, trying to put him back together. But fortunately, he had uninsured liability coverage that came in and paid for his medical bills. So it's definitely something to be aware of. I think a lot of people don't know how common it is for people to not have insurance. So I think every year or so it's a good idea to take a look at your home and auto coverage, make sure it has the coverage that you need, and then right now it definitely makes sense to shop around a little bit to make sure you've got the best deal.
Now, Harrison, I mean, you don't sell insurance, but when you have people come in for a financial planning consultation, become a financial planning client, is this an area that you also look at?
Yeah, this is definitely something that I look at. Every policy, I'll take a look at the coverage, the deductibles, how much coverage you got for everything, what premiums you're paying, what company that you're with, and then I'll point out if I see something that needs to be changed. There's a couple different brokers that I work with, and so I can look at it from an unbiased perspective and say, hey, this is something that you might be able to reduce the premium on, or hey, this coverage looks a little lacking. You might want to go back to your carrier and have them adjust that, or talk to a broker about switching companies.
Good. All right. Well, that's I think a very good point for people, because I think a lot of people don't realize that, oh yeah, I'm fine, and they may have bought the house years ago, their net worth has gone up, and they kind of didn't know about the umbrella policy, all these different things. I mean, it's a very important part, because your chances of having that happen are low, but if they happen, it could wipe somebody out.
Yes. Yeah, exactly. So insurance, unfortunately, is necessary. So it does serve a purpose, and you want to make sure you have the right amount of coverage and you're not paying too much for it. Great.
Well, Harrison, thank you very much. You have a great day, and we'll see you on Monday.
All right. Thanks, guys. We'll see you Monday.
Okay. Bye-bye. Again, that's Harrison Johnson. He's our financial planner. He's a CFP. He's on a salary, so he doesn't sell annuities or life insurance. He really is doing a true financial plan for you. If you want a free consultation with him, give him a call at the office, 858-546-4306. That's 858-546-4306. Or you can contact him by email. Go to our website, smartinvesting2000.com. That's smartinvesting2000.com. And again, you can set that free consultation with him about financial planning. All right, phone number's here, 833-288-0973. That's 833-288-0973.
I did want to mention just real quick, I mentioned it a couple weeks ago, but for my charity, the
golf tournament.
Golfers,
yes.
Golfers, if you're a golfer out there, I think you'll have a great time. Actually, I know you'll have a great time at my golf tournament.
This is what, the third or fourth year?
This is the third year.
Third year. And every time everybody says what a great golf tournament it is.
Great tournament. We got prizes. We have gift bags. So it's a lot of fun, and it's a nice day on the course at the Rancho Bernardo Inn. It's 2 weeks from today, so August 19th. And again, all proceeds go to my charity, the Fighters Fight Foundation, which is a breast cancer charity that provides unforgettable experiences to women battling breast cancer. So a lot of fun. Just want to put it out there for people that are golfers, because it's a nice time in San Diego. And I think it's one of the more reasonably cost tournaments in the San Diego area.
It doesn't break the buck, the bank. And I think your fund per dollar is very, very high.
Yeah,
so
I think so.
And how do they sign up for it? How do they get a hold of you?
That's probably a great idea. Yeah, just go to the website there. It's fightersfightfoundation.com. Again, that's fightersfightfoundation.com. Or if you have questions, you can always contact me at the office at Wilsey Asset Management as well.
And what is that phone number?
858-546-4306.
All right. Phone number's here, 833-288-0973. That's 833-288-0973. We had Jim that called in, but he had to go. We saw he dropped off the lines. But he wanted to talk about Cigna. So we'll look at Cigna for Jim here in San Diego. Their symbol is CI. They're the healthcare plans. Institutional ownership is 89.4. And we got numbers here already as of June 30th. So the PE ratio on Cigna, 13.1, well below the industry at 21.1. Price to sales, 0.5 versus 0.7. Price to book value, 1.9, below the industry at 3, which is a positive. And price to cash flow, 6.7 versus 8.1. PEG ratio is only 1. That's about a third of the industry at 2.9. So all the valuation ratios looking pretty good here. Now, we do see some great growth. We got earnings grew over the last year by 30.3%, above the industry at 20.4. Sales, unfortunately, only up 3.8%. The industry was up 11.7. The 5-year estimated growth rate from analysts, 11.1%. That's pretty good. They do say the industry will be up about 11.5. They pay a 1.7% dividend, only use 21% of their earnings to pay that out. They're insurance companies, so balance sheet is a little bit different. No current ratio. Debt to equity 0.7 versus 0.8. Net profit margin for Cigna, well, that's 3.6 versus 3.1. And return on equity 14.6. We generally like to see it around 15, but I'm okay with the 14.6. Case?
Looking at the current price here for Cigna, again, ticker symbol is CI. It's $286.58. The 52-week range, well, it's $240.50 as the low, $340.11 as the high. Year-to-date, the stock's down about 10.86%. Now, if we go forward for the company, we go out to, again, December 2024. Having some technical difficulties over here, switching over. So let me get that number. There we go. It's $28.27 is the estimated earnings per share. So if we use our estimated multiple of 16.6 on that, we get a target sell price of $469.28. I mean, the company trades at 10 times future earnings, essentially. Right. I mean, it's a great value. And, I mean, the growth here is pretty nice as well. I mean, the company is looking for about 6.5% growth this year, 14% growth on earnings next year, less analysts going out to 2025, but 12.6% growth that year as well. And you actually look at the company, I mean, they talk about it trying to achieve that double-digit earning growth over time.
Right.
I mean, gosh, a 10 times earnings multiple and double-digit earnings growth? Wow, that sounds like a pretty darn good deal to me.
And year-to-date, the S&P's up 17.5. They're down 12.7% year-to-date. I mean, this is what we talk about, things on sale. It doesn't mean you buy it today and then tomorrow, like, oh, wow, I'm making all this money. It could take months for it to turn around. But again, the way we look at things, saying you're buying a great company with an aging population, with a rising cost of insurance, this is how they're going to get that growth. So you want to be invested in a company like this that's on sale now with good growth.
Actually, I'm going to counter that because that could actually hurt them as well in the short term, because what happens with the aging population is all of a sudden the costs start to rise. Yeah. But what happens is costs go up, then they have to raise their prices to offset that. So that's where insurance, I mean, frankly, insurance companies are built to win, because they have to make money. We need insurance because you can't have somebody go in and all of a sudden they have $1 million hospital bill. You can't afford that. So we need insurance, and they need to stay in business. They need to stay profitable. And the big reason why they are so profitable and great investments is they take those premiums, they invest those premiums, they buy back a lot of stock. I mean, I think insurance is a very good business to invest in because it's not necessarily simple. There's a lot of actuary tables and things that they got to look at, but the design in the business is, I think, a good investment.
And it's one that you'll have those peaks and valleys because, again, when claims go up, the price of the insurance is going to go down, whether it's health insurance, property and casualty, auto, whatever it may be. And then what happens, they have to raise the premiums, and then they are profitable down the road. It's not a short-term trading vehicle or short-term investment. It's one that, I mean, gosh, we've had an insurance company in our portfolio now for, I think, like 13, maybe 14 years. It's done extremely well for us, but there's been bad periods. And during those bad periods, we say, on sale, let's buy more.
Yeah.
And then when it goes way up, we've actually pared it back because it has become over-concentrated, so we'll pare back a little bit. And then when it goes down, we'll use it for something else.
Yeah, and it is interesting as well. I mean, looking at the political side of it, when you look at right now, generally, I was reading an article about it and talking about how health insurers don't do as well under, Democrat presidency just because of the concerns from like your Bernie Sanders of Medicare for all. I still don't foresee that happening. I think that would be a disaster to have government-based insurance for that. I just don't think it's going to be a viable solution. So I think that, they could get a pop. Next year, it's an election year as well. I mean, you have seen historically if a Republican comes in, again, based off this article, they do better during that time period as well.
Yeah. And even during the down periods. I mean, because I think if we looked at Cigna, I think if we looked at it since Joe Biden got in office, I do believe it's up since he got in office. So they just do well. Yeah. But you're right. They do better probably Republican versus a Democratic,
And I'm going to let you know, don't buy it because Chase said there's going to be a Republican in office next year. I'm just saying it's something that could be intriguing. I thought it was maybe I had this professor in college used to call them tasty tidbits.
Tasty tidbits.
Yeah, it's a fun piece of information. So don't buy it for that reason. It was just, something to consider for next year.
Buy the business because it's a good business that's on sale and it will do well whether a Democrat or Republican in office because of the type of business that it is. And also, too, I don't see that, how technology could ever replace this business. They can enhance the business, but never replace it.
Yeah, no, I absolutely agree with that.
Yeah. So, all right, gosh, phone lines are all open. 833-288-0973. That's 833-288-0973.
I did want to talk about Amazon too. I did look that up because we brought it up earlier.
Yes. What do you got?
I just some interesting numbers on it. So it was worse than I thought, better than you thought.
Okay.
It came in at 12% in Q2 was their AWS growth.
And that's year over year or quarter?
That's what it looks like is year over year. But that was a deceleration from the prior quarter when sales expanded 16% on AWS. And this is actually the slowest growth since 2015. For AWS.
Yeah, so that's why I may have misunderstood the number, but I knew it wasn't good. And I do remember that they got that high multiple because, the AWS is growing at, I think, 25. I think even I heard one time 40%. That growth cannot last. And 12%, good growth, but a deceleration of the growth, what could it be next quarter? Because the thing with growth, too, is that, there is more competition out there now for the cloud services. Your number is bigger. To try to get that to grow, again, 12% next quarter over the previous year, it's not easy. It gets harder and harder.
Yeah, and I did want to point out that the crazy thing, I didn't know this. I knew it was a big part of their business, but, obviously the retail side of the business gets all the kind of headline in terms of driving sales.
Right.
But AWS accounted for 70% of Amazon's $7.7 billion operating profit.
See, and that's very important because people say, I love Amazon because I love their products and so forth. So you're telling me that about 30%, they have other businesses too, but
they have advertising as well, which actually that grew pretty nice, jumping 22% in the quarter. That's $10.7 billion in sales.
Right.
So I don't know in terms of profits, it's not breaking that out, but I mean they do have some other businesses, but the AWS is still what is the ultimate profit driver there.
So actually the retail side, maybe about a quarter of the business comes from the retail side, which I believe is a money loser for them.
I don't even think of it as a quarter if they have the other businesses as well with advertising. And I mean, they have Prime, which is reoccurring revenue, but ultimately it's going to rise and fall based off AWS. And, I think about people that bought Amazon and they bought it for the retail side.
Right.
And it's like, you missed Amazon. Nobody knew AWS was going to come about. Right. Amazon doesn't do well because of the retail business. The reason the Amazon stock has done well is because of AWS, which is, quite frankly, no reason that people 5, 10, 15 years ago bought Amazon for.
Yeah, no, they didn't even know about it or could understand it. So that's one thing that you have to look at the business. And again, that's a great service when you hear about it. And I think, and I don't have Prime. I think you have it. My other son Nash has it. We needed light bulbs for the house. And I think he ordered them in the morning. I'm pretty sure they came in the afternoon. Like, it's not even 24 hours anymore.
It's amazing. I mean, they talked about it as well. They're going from a hub and spoke model is what they called it to a more regional focus thing, and they're really getting good at that same day delivery, which it's kind of scary how good they are at it, and they're kind of like pre-filling inventory based off of technology. And this is again talking about how technology can enhance things. Is they're trying to pre-fill things and then have that inventory available. So then once people order it based off previous ordering records, is then you can fill that much quicker.
And I know my wife is a Prime member. Every doggone day, there's at least one, if not two, packages there. That's why I don't want to sign up for it, because it's too easy. You'll start spending money. I don't like to spend money. I like to invest money, not spend money.
Well, I hate to break it to you, but if your wife's already a Prime member, why in the heck would you need to be a Prime member too?
Oh, that's right. Well, I just got married a few weeks ago.
Well, you guys have lived together. You don't need two Prime memberships in one household.
Can we use separate credit cards?
Yeah, you can actually put different credit cards on there.
Oh, well, maybe I should do that.
Yeah.
I'll get some benefit there. Hopefully she's not listening to the show. She never listens to the show. She doesn't like the show. She doesn't like investing. She just wants to go shopping all the time. All right, well let's look at that. We got quite a few callers coming in here. I'm not sure which one I'm supposed to go to because I see all flashing lights. He's giving me the hand to hold on for a second, so we'll just talk for another minute here. And I would kind of want to go to Amazon to look at the numbers, but it's too early because the numbers won't be there yet. So maybe next week, somebody calling about Amazon so we can take a look at those numbers. But I still think it's way too expensive. I mean, the PE is still probably around 50. Even going forward, it'll give us another quarter kind of look at those earnings going forward. I still don't think they're going to be worthwhile.
Yeah, I mean, it trades at 47 times future earnings.
But that could change next week because analysts could
increase earnings,
maybe decrease earnings. I doubt it, but possible.
Yeah.
How many analysts do you have that up?
45.
Yeah. So, I mean, what could happen out of 45 analysts, you could have one or two that maybe drop following it that are on the high side, or a few that say, we don't think it's going to do as well. So I hope that next week somebody calls in about Amazon and hopefully the numbers are updated so we can take a look at it. So, all right, we ready to go to the phones? Okay, let's go to Tony out in San Diego. Good morning, Tony, on the Smart Invest Show with Brent Chase. How can we help you out?
Good morning, gents. I recently received a notice about Johnson & Johnson making an offer to, trade shares out with Kenvue. And I wanted to understand how that works because it's not a typical spin-off. I mean, usually when companies spin off, you just get shares in the new company. But in this case, they're actually offering to trade shares of Johnson & Johnson with Kenvue. And I don't understand how that works or why they do that.
Did you try to pull up Kenvue, Chase?
Yeah, I don't think it's a public company yet, so we can't break anything down. But
yeah, I mean, that is not very common. And what you really have to do is you've got to look at this Kenvue to say, well, first of all, is this worth doing? Why is Johnson & Johnson doing that? I'm trying to analyze on air. I can't think of why they would do that. It's not making sense to me. And we could be missing something because I'm sure if they offer that, you probably got like a 50-page prospectus on what's going on behind there. Once you get all the details,
I think it's 293 pages.
Yeah, so I've been generous there. So read the 290 pages. Call us back next week.
I was going to say, I mean,
so essentially, I think what they're doing is taking certain of their consumer brands and spinning it off to this other company. So the Johnson & Johnson focuses more on, new drug development and so on. Whereas Kenvue would focus on the typical brands like Band-Aid and so on from the past. I've seen this with a couple of other companies before where they've spun off the consumer side of the business and, haven't really done all that well with the spin-off. But this isn't a spin-off. It's they've just created this new company, and now they're offering to swap shares in it, which seems very odd to me.
Yeah, I mean, I don't think I would swap shares just because it's again, you don't have as much data that you have on a J&J where you have that business that is there, and you'll have to see what happens. And I'm not sure. I haven't looked at this, but I know that there was kind of some flack for J&J, obviously, around that talc issue.
Yeah.
And they were talking about spinning off a company. Who's going to have the liability of the talc powder situation? Because if it's Kenvue, it's like, I don't want that company.
No.
So I would definitely want to look closer at that deal, and I'd have to assume Kenvue would take it, because that sounds like, I mean, it looks like they're going to have the Neutrogenas. You talked about the Band-Aids. It's the consumer side, where J&J is going to have more of that pharmaceutical type businesses. So I would assume the talc is carrying over to Kenvue, but I haven't looked at that situation in a while. It's definitely something I would want to understand.
Yeah, it's kind of like they're just trying to say maybe people won't notice, and we'll do this Kenvue deal. But even Johnson & Johnson, I'm looking at, I mean, it's very expensive.
Yeah.
I mean, trades at 34 times earnings. I mean, that's expensive. You're not getting a deal there. So maybe they're trying to move some things around. I don't like many times when companies do this. It's too confusing. You can't understand it. No one's going to read that 300-page report. I like things simple. So I would say, based on what we're kind of looking at, I would not do the deal. I'd say, no, let me stay with what I know, as opposed to risking going to something I don't know, this Kenvue. So, all ready?
Point. Very good. Well, thank you.
Okay, Tony, thanks for calling. Have a good one.
All right.
Bye-bye. All right. I'd say that opens up the phone line, but we only got a few minutes left here. I mean, time just goes by so quick. I was going to talk about the counterfeiting. Do you have anything else you want to talk about before?
I mean, I was just going to, since I got a couple minutes, I was just going to carry on with the whole spinoff situation. It is interesting, because it's important to understand that these spinoffs can work in different fashions. I mean, sometimes they, like with Warner Brothers and AT&T, when that spin-out occurred, you just got the Warner Brothers shares, and you could have sold them and bought an AT&T, but you got the shares. There wasn't really any other option, essentially.
Right.
So, it's one thing that you have to understand as an investor. When these happen, what do you do with that spin out? Are you going to keep it? Are you going to sell it? And it's important you read the deal, because there's going to be, different types of deals that come about from the spin outs as well.
And it is so important to really think about what you're doing, or your investment advisor should be looking at what to do with those, because you've got to analyze the current company and then the new company and say, well, what do I have here? Because many times you should sell off that spinoff, because many times they take all the debt and they get all the crap. But you've got to do the homework. You've got to look at it, and now you've got not one company to analyze, but two. And
also, how big of a position I've seen this happen before, people that keep out, and then all of a sudden it's like 0.5% of your portfolio. What's the point of even having that?
I was going to say 0.1 or 0.2 even lower.
I was being generous.
Right.
Yeah, so, it's definitely something that you want to understand is, is it worth it to keep that business if it's such a small portion of the portfolio? Or, I mean, maybe if it's a good company, you add to it. Or you just sell it and buy back into that parent company with what you sold, so you keep your allocation the same. I mean, there's so many different ways that it could head, but you got to look at all the numbers and look at each situation individually.
And we talk about being 0.5% or 0.1%, whatever it may be. For some people, that doesn't matter, because they will have 50, 75, 100 positions in their portfolio, which we don't do that. We run a concentrated portfolio, because we say you can't know much more than about 15 to 20 companies to really do good research. There's no way possible you could research properly 50 companies or 50 investments in your portfolio. So for some people, like, well, what difference does it make? I've got 50 positions, so 51. But that's not, in our opinion, the right way to run a profitable portfolio. It should be more concentrated about the investments that you have.
Well, then that just gets confusing, too. It's like, you don't even know what, I'll use Kenvue. You don't even know what a Kenvue does. Why do you hold it? It's not like a J&J where you actually know the name. It's like, what is this like 5 years from now, you'd be like, what is this Kenvue company?
Right, why did they do that? Yeah. So, and that's why our clients do feel very comfortable, because they know that we know these businesses very well. You can call me or Chase anytime you want to. And what's going on with this? We can tell us. Well, this is Closing Bell. So thank you for listening to the Smart Investing Show. It is for information purposes only and should not be used as investment advice. If you would like to discuss in more detail your investment needs, have other investment questions, feel free to call myself, Brent Wilsey, or Chase Wilsey at 858-546-4306. Again, that's 858-546-4306. Be sure to visit our website, smartinvesting2000.com. That's smartinvesting2000.com. You can sign up for the newsletter there. It goes out every Friday at 5 o'clock. It's there on the website now. Thanks for listening. We'll be back next week right here on the Smart Investing Show.
To learn